Hey, welcome everybody to the 40 Finance channel. We talked a little bit last week about the stocks that were going down and where the potential opportunities might be. And over the weekend, I published a new video where I was going into detail about the four kind of signs that I was looking for, like the four horsemen of stock apocalypse, as I called it. And there was a couple of those events actually happened over the weekend. In fact, I had to finish that editing that video very quickly because one of the signs was looking at other oversaturated markets, if you will, and looking for weakness in there. So not just stocks, but things like collectibles, and then obviously Bitcoin and the crypto markets, which saw a downside on Saturday that we'll get into here in a minute. But some of the things that I didn't see last week, right, where I was talking about like, hey, this, PayPal could go down more, certain stocks could go down more. And it's not necessarily important to find the absolute bottom, but some of the things that were still strong last week are finally showing a few chinks in the armor. So I thought I'd start off today with kind of reviewing these new signs that I'm looking at. And, you're never going to time an absolute bottom, but just to be clear, where I sit in this particular environment is staying with strong stocks that have profitability and EPS. I keep saying that over and over, but for me, it's really my grounding point. If you can support an EPS, it really helps your valuations. If we get into the type of market where people are going through stocks and looking at valuations and talking about what's cheap and what's not, having an EPS really makes a big difference. And the concept of P ratios has sort of slipped away in this bull market. There's a lot of people who are using other underlying multiples, and I get it. There's a lot of different ways to look at a stock. But at the end of the day, if you at least have a steady portfolio, or at least half of your portfolio right now in stocks with, a fundamental EPS, a fundamental P ratio that's within range, I think you can feel pretty good that those stocks are not going to go down. Their floor is limited on how far they go down. Microsoft's floor is limited, Google and so many others, because it's only going to go down so far before people are like, well, over time, you've never been able to buy Microsoft for this cheap, right? So that's what I'm kind of trying to stay in tune with. And one of the ways that I'm adding weight, if you will, to the more conservative side of investing is with the QQQ. And one of the things that was mildly disappointing, I think, last week is for all the stocks that went down, a lot of people ran into the larger cap stocks. So the QQQ hasn't seen a ton of weakness, in my opinion. And certainly if we had a broader event, we might see that. But I'm trying to balance with just one or two shares here and there with QQQ to make sure that I'm strong on the fundamental side of the portfolio. And then if you want to get in and dig through some growth stocks, there's plenty of them out there that have taken huge hits. It's a little bit harder to tell what your fundamental floor is for some of those stocks, particularly those that are profitable. But you can go for it, but I would just say make sure you have plenty of chips on the safer side of the table at least while we're in this volatility. All right, so let's take a look at some things that, in my opinion, are good news if you want to talk about perhaps reaching a floor to some of this madness. And I don't think we're there yet. I don't think you can take this Green Monday and just say the storm is past. But it is good that we've seen some positivity. If we start with the QQQ, and let me drag this out a little bit. If we start with the QQQ and we just look at the 1 month, We did have a little bit of a bounce back into here in December 6th. What I've been talking a lot about, and I stick to it. Let's switch this to a 1 month and make sure you guys can see it. Drag this down. All right, it's not picture perfect. Let's get this in here a little bit better. All right, but you guys know that this purple line down here is the RSI, and I've said this a lot lately that I was kind of hoping for an RSI in the 20s to feel really good about the Q, but it is at 35, so it's lower than, you know, maybe average, certainly the most recent average. Let's take a look at the 3-month view. So on the 3-month view, sitting at 33, and we know that it can go, if we look over here in October, we know that we can get in the 20s. We haven't seen the 20s yet, but we're dipping close to them. That is a good sign in the sense that, you know, a lot of the selling is going on, and there's just a certain point to it that it has to bounce back, I would say. Still running above that 50-day moving average. However, I still think that you could nibble on QQQ, particularly if you have no intention to sell for 5 years. I don't know really how you can go wrong buying any dip on this one. All right, so that is one sign, and that's not really a huge weakness sign, as we saw with, you know, the RSI being what it was. But we did get, finally, some weakness in NVDA, and I say that as NVDA is a great company, so I'm not ragging on them, but there's no way in heckfire that you're going to see a forward, you know, a trailing PE of 90. And by the way, how's it going, Andre and Igor? Thanks for typing in the chat. Always get a little nervous that it's not working until I see the first message. So, but we've talked about NVIDIA. Forward PE at 62. This might be, yeah, this is as of 12/3. So this stock needed to come down. I don't think we could talk about a bull market, or excuse me, I don't think we could talk about a correction or bear market or anything until this stock came down, you know, certainly from this number 342, and we started to get some weakness in the later half of last week. And I think it might very well have more room to go, but at least something chopped off of it. And this is a big component of the QQQ, right? So anytime NVIDIA goes down, theoretically, the QQQ should go down at least a little bit. A lot of it depends on if the other big players in there, Microsoft, etc., see some of their dollars squeak out. So we had NVIDIA. I think that's a good sign for reaching closer to the floor. And we finally see Tesla under $1,000, which I think is another really important factor for getting closer to the floor. Tesla fundamentally has been overvalued for a while. They are not nearly as overvalued as they were, say, 2 years ago because of the EPS that they're producing now. However, you know, P ratio trailing 12 months in the 300s, forwards probably close to 100. You know, it's still an automaker at some degree, and even if it's a technology company, you know, plus 100 here and a PEG ratio at 269, no one's going to say that that stock is cheap by any stretch. So I, for one, believe that it's good news that Tesla is dripping out a little bit, and I don't wish anyone's stocks to go down. I do not own Tesla, but it's good for the QQQ to get some weight off of this one. One that just popped in my mind that I haven't checked on is Microsoft. Microsoft and Apple are the leaders of the Qs. So again, we're just looking for some weakness to make sure. And we got it a little bit. Microsoft high on November 22nd, 350 in the 340s. It's shaved off a little bit. no one's going to argue that it's wildly overvalued, but if you just go to from a historical standpoint, as I've shown time and time again, Microsoft is trading valuation-wise above its historical norm. So you're at 35 here. Doesn't take long to go back pre-pandemic and even into June of the pandemic and see that you probably have a couple points to lop off there. Now, with that being said, we still do have our low interest rates. Let's see how that's going today. So we still have 1.39 on the 10-year, even as trading's been open for a couple hours. So whenever you're at this low, there's always going to be the argument for growth stocks because of returns. I think the writing on the wall is, though, that the interest rates are likely going to be going up over the next year. So that would just lower the valuation multiple of a lot of stocks, probably including Microsoft. Maybe it doesn't get back down to here at 24.21, but maybe it goes to 30, right? So that's another 5 points off. And if you take 30, and let's see what the average estimate is, 9.2. So let's just raise it to 10 because Microsoft's been doing very well. So 10 times 30 is $300. All right, so that's just simple math. And I would say about $300, and I was, is probably a safe zone for Microsoft in the short term. All right, let's take a look at what other headlines we have going on today, and then I'll get into some questions as always. So this is just CNBC, and apparently Tesla is being investigated by the SEC. Whistleblower complaint alleging the company failed to properly notify its shareholders of solar panel defects. Shares of Tesla were down about 3%. So that might affect the stock a little bit. There's a lot, anytime you see these SEC probes, I'll be honest, they happen to almost every company. You have to think about, where could this really go? All right, so this particular complaint is not one that I think affects the end user. It's a complaint that is coming from shareholders or a representative of shareholders about notification. So, I don't know how much this is really going to affect Tesla's company as a whole, to be honest with you. And as a stockholder in Visa, who is regularly probed by the, big ad there, sorry, by the SEC, I can tell you that half of these things that come out never really materialize in any way. You also have this Trump SPAC, which I know was popular maybe a month or two ago. I don't know anything about that SPAC. I haven't invested in it. But if you did, keep in mind that there's something going on with it, so make sure that you are monitoring your stocks if you have them, because there's something going on there with the SEC. And maybe, just be ready to bail if you think you got to bail. Again, SEC regulations in general, or hearings or whatever they do, investigations, they take forever. Absolutely take forever. And whenever you see, the news loves those headlines because it sounds like superficial, like a drug raid or something. But what I can tell you from experience, having many stocks get headlines like that, is they take forever. The onus is on the SEC to prove the company was wrong in certain regulations. That's not easy. And so, as you know, in America, innocent until proven guilty. The burden of proof is on the accuser. That's a little bit different of a court setup than you have in other countries. So when the burden's on the accuser in anything, you have to come in with some hardcore evidence, And normally in complicated business matters, it's very, very hard to prove that somebody willingly, if that's a word, tried to break the law or was trying to misrepresent. So, good luck to everybody whose stocks hit an SEC investigation. If you're in a company that's at least probably 10 or 15 years old, you've probably already had one. All right. The last thing I want to show that we probably all are aware of at this point by now, one second here, is Bitcoin finally saw a dip. Bitcoin / crypto in general. One second. And these are the coins that I watch. I just have a little bit of money in crypto and really for the long term, but you see this 7-day chart across for Bitcoin, Ethereum, blah, blah, blah. And this to me is good for finding the bottom of the market. So I do like the opportunity that there is in crypto. I cannot give you a valuation on any of these coins, but I will say that getting some money out from this market is a good sign towards reaching the bottom, right? So it's kind of like this acceptance that I think a lot of people who look at fundamentals like I have for so long, it's accepting the fact that the market is running hot. All right, just understanding that you can read the headlines that say to the moon, this company is going to change the world, blah, blah, blah. All those things can be true, all right? The stocks can go to the moon. Companies can change the world. Crypto can change the entire way we, navigate through money. But on the same token, nothing goes from 0 to 100 in business world without challenges and without obstacles to their theories, right? So the world famous one right now, of course, is Tesla. And when they came out and EV cars and you had plenty of doubters, now we know, thanks to Tesla and others, that there's definitely a market for the EV cars. But perhaps there's some of these EV manufacturers who, are selling the world of 100% EV vehicles. That's what their stock value is based on. Guys, that's going to take a long freaking time. All right. And now every year, the percentage will grow substantially. But if you're looking for, I need to wake up tomorrow and see what my stock is doing from an EV perspective, the world just doesn't change that fast. And I can tell you from someone who studied a lot in consumer, United States consumer tastes do not change that fast. And for every, 25-year-old and 65-year-old you meet out there, you're going to get super different views on how quickly they want to acclimate. And when 25-year-olds get to a certain age, I'm just going to say 35, and there's families and there's houses and there's other commitments going on, their views and tastes typically change as well, because there's just a difference between risk and preventing loss. So my 2 cents on there. Kevin Hawthorne, how you doing? Good to see you. Speaking of EV, I'm going to do one more and then we'll get into questions. There was, let me bring this over here. I'm just going to go down here. One of the EV companies is not having a good day. Let's see if I can find this. Here we go. Here's our friends, the SEC, apparently at work in the EV industry. Lucid said it received subpoena requesting the production of certain documents related to an investigation, if that can be any more broad. Lucid is latest EV. That doesn't help us too much. Requesting the production. Investigation appears to concern the business combination. All right, so they must have merged, yes, between the blank check company Churchill Capital. So again, SEC looks like they're busy here at the end of the year. And just make sure you're following stocks that might be affected, and just make sure that it's a nothing burger, because a lot of times it is. All right, checking in on the chats here. Hopefully not far from the bottom is what Andre led off with, and I agree. I think that there could be more room to run. There probably should be more room to run to the downside, but we're just trying to figure out like how much farther it could go. So when I did that Microsoft, just that quick math, 30 forward PE, I took their end of year projections. The consensus is 920. I gave them $10. That gives you $300 stock price. And with that, that just puts you at valued, or fully valued or fairly valued, however you want to look at it. Not necessarily for 10 years, but just for the look ahead to 6 to 12 months. When I don't own Microsoft, is this a good time to get into Microsoft? That's what that valuation is. It's not a 10-year projection by any stretch of the imagination. So to Andre's point, there probably is this whole nother universe of stocks being on sale, right? So dropping from high value to fairly valued and then dipping to on sale, that's a whole nother game. And that's probably a whole nother 20% leg down or something like that. And on mega cap, it's probably another 10% leg down. That would be, roughly, that would probably start to put Microsoft at the 280 range, something like that, where you're like, holy cow, this is a no-brainer. Stock is on sale. I'm not going to think twice about buying this. And that's, I don't think we're quite there on that yet. Ismail, how do you see Medtronic and Salesforce? Take a look at them. I don't know what's up with Salesforce in the sense that it just keeps getting hit on seemingly good news, but I haven't checked in on it in a while. Let's see what we got. 6 months, yep, looks like it just took another blast to the face. 296 on November 29th. Now you're at 251. P ratio of 100, that's trailing 12 months though. I think there was a time with Salesforce due to acquisitions, and I'm going to pull this out, that their earnings were going to be a little flat, and it looks like that's still going on. Yeah, so 492 last year, drops to 468 this year, and stays, projected about flat at 470. So your EPS anyway, / PE, doesn't look like it's going to change a ton. In fact, it's going to go up. What do we say they're at right now? So EPS of 182 on this calculation. So actually, if that holds true, this could be up. This could still be a win. Salesforce could be a company where the trailing 12 months may not best represent their full EPS, because sometimes with contracts and whatnot, money comes in at different times. And maybe they're expecting a boost in Jan 1. I'm not sure, but it's something to think about. On the growth side, you got 20%. I've heard nothing but good things about Salesforce in general, but I think maybe it just got a little ahead of itself. Let's see if we can find, you guys probably, see if I can squeeze this in. So you got an RSI in the 20s, which that's good if you're trying to buy. Now you did hit 18 recently on 11/26, but if you compare that, let me go out a minute. Oh, we're in 3 months. Let's go year to date. So on the year-to-date side, you've got 27. The lows were May, like everybody else, at 24, and 20s, like everybody else back in March. So this could be a good time. I mean, you're bouncing off 200-day. If you believe in the company, I haven't studied it in detail as far as product launches and whatnot, but there's a lot of evidence in that particular chart that says this is a pretty hefty low for Salesforce. Now, does that mean it can't go lower? Not really. However, if you are thinking 3 to 5 years and you've seen their product roadmap and you're like, oh wow, this feature's coming out, they're expanding into this space, that stuff takes time. And if you like what you see there, then I would say it's very weak right now in terms of support. It's very, very weak. So keep your eyes on it and maybe add some if you believe. But it has to be longer, I would say, than a year or so. That would just be my opinion. All right, you also asked about Medtronic, and I believe this is like hospital supply. Let's see what we got. 1 year eking down. I mean, this is the kind of chart that is, I would say that this is the kind of chart right off the bat that's exciting on a 1 year basis because you're going down from where you were the week before, or the year before. Let me read something here, make sure I understand this company. Yeah, device-based medical therapies to hospitals. Okay, got it. That's who I thought it was, but I wanted to make sure. Let's see what their projections are. This is strong. Last year, $4.44, going to $5.70, then potentially to $6.19. Single-digit growth rate is not ideal in terms of building momentum, but you have more than single-digit EPS growth by my calculations. Let's take a look at the history. Go annual, forward PE, 1869. Pretty much in line if we go way back. Medical device, that screen keeps refreshing on Yahoo lately. I don't know why that is. So I have to switch it all back. Okay, so back here, pre-pandemic, you're obviously 16, 17 forward PE, 1869. You're barely above that. PEG ratio under 2, not terrible. It could have a little bit more to leak out, but that's not a bad buy. And I'm saying that only on fundamentals, okay? So sometimes when you guys ask like about Medtronic, it's not a company that I know like their entire product line, et cetera, et cetera. But I would say fundamentals there, Ismail, I would say fundamentals for both of the ones that you brought up, Salesforce and Medtronic, they've got some weakness to them, and it looks like they have fundamentals that would support their value to not go down much further. It doesn't mean that they're at the floor. It just means like, hey, with what that company's doing, particularly in medical devices, which I assume is an industry that's not going away, might have something there. All right. Mr. Chada, what do you make of Snow? Snow boomed last week, I believe. I think they hit earnings right on the head. Let's see what we got. So the big chart, you are a couple bucks below the IPO last year on December 7th. It was an IPO. When was the IPO? Okay, October 1st was the IPO at $250. Now this is going to be a harder one because I don't think we have profitability. No. All right, so you're moving in direction to profitability. My guess is profitability in 2024, just looking at these takes here. You got a 100% increase in sales. 65% projected for next year. So this is good, and I would say they're in software, so you can expect cumulative returns over time, assuming they hang on to their customers. Let's keep this 65% growth in mind. And for stats, we know we're not going to have any EPS or anything. We do have price to sales of 100. Back in October, it was in the plus 100, plus 100, plus 55. So this isn't the cheapest it's been when you look back to April of 2021, but it is relatively cheap on price to sales compared to the past. There's a couple things, though, that could lead to Snow dropping more. One is, 20x price to book. The other is, no matter how you slice and dice it, 99 times your trailing 12-month sales is a little bit scary. So if you are trying to avoid the floor on Snowflake at 342, I'm not sure you're going to do it. However, you just have to be familiar with this technology. You really, really do, to feel good about this one for the long haul. I would be inclined to say that a stock like Snow is at further risk of going down simply because of what we've seen from all the other growth technology stocks. So tech across the board, particularly software and technology and subscription, have gotten hammered because they were on such a peak fly, they were flying high since the pandemic, and deservedly so in some degree because everybody picked up on those. Now, if you're going to get into enterprise technology, people who are selling to large clients, not to people like me, right? Not to people like you. It's all about selling to corporations. I would suggest you start looking at what they call CapEx spending, which is where corporations allocate dollars for things in 2022, so next year. They've probably already done it. How much investment in the space that Snow is going for, how much investment from corporations are going to come in there, right? And then you have to hope that number happens, right? So if the projection, here's an example, if the projection of CapEx spending in IT is 30% more than this year, okay, across the industry, and Snow's little niche, which I believe is database reporting or security, one of the two, if Snow's little niche is still expecting that CapEx growth, that's all good news and very strong signs for corporate contracts to get renewed and or signed. Now, when you have the situation that we've had here in the past 2 weeks, where now all of a sudden you have maybe some pandemic concerns, and you also have perhaps some interest rates concerns, which could affect lending at corporations, or should I say borrowing, that's where those like 30% projections can fall back on their butt. Because if a lockdown type situation happened again, corporations, as we see, we've already noticed this, that they're just going to freeze spending. And if Snow was going to sign, I'm just going to pick a Google or something. If they were about to sign a big contract there, corporations freeze, then Snow doesn't get the contract. It changes the whole look of the company going forward for at least 1 year. They might still get the Google contract, but things get paused. So that's my take on Snow. Anyway, you don't want to have to rah-rah your stocks, right, that are potentially overvalued. You don't want to have to defend the elevated valuation, and that's a place that I think Snowflake is in. So if we looked back at Medtronic, which was a user submission here earlier, I would say that Medtronic, just by eyeballing it, now you're defending value. Okay, it's the flip of a coin. Now you're defending that this company is going to do XYZ and the EPS is growing and the current valuation multiples are just about in line with historical average. If Medtronic went to $99, you're defending the value as opposed to defending the overvalued. And defending overvalued can get tricky. It wasn't last year and it wasn't in 2020 because everybody was buying the rocket to the moon stories, but it can get trickier in a, let's just say, a more conservative investing environment, which we're probably going to, see here in 2022. All right. Eric Lee regarding ad tech sector. Yes, ad tech sector. So one of my stocks, we've talked a lot about ad tech here lately, but I own Magnite that I'm sticking with for now. I have no plans to sell for now, and it could very well be a double down for me. I look at it every day and I think about doubling down. My cost basis on this one is 29, so it's very, very close to that minus 50%, I think. I'd have to double check what my cost basis is. So with that, anytime you're minus 50%, you really have to look in the mirror and say, geez, maybe I should just sell this for the end of the year and then buy back in January. I do believe in Magnite. I do believe that, their client list, which includes Roku and Disney, and they're on the supply side of things. I do think advertising is getting hit with the so-called supply chain problems, right? So just the argument that if you have a bulk of inventory that you're trying to sell, then you advertise to sell it, right? So right now, we don't have a bulk of inventory, particularly in automotive. There's just no cars to really sell at certain levels. So that could be a hit. That's probably a hit to what we're seeing in ad tech right now. Travel is a flip of a coin. So travel is a big part of advertising spending, aka ad tech. And then on even the retail side, when inventories are limited, you don't need to clear inventory. So that when you think about Black Fridays and clearance sales and all the things that we typically see, when you don't have a lot of something, you don't need to clearance it to the moon. So in fact, I think we saw on Black Friday that discounts were much less in certain categories than we've seen the year before, and that gets back to the supply chain, and that's where the bearish scenario right now is for ad tech. So Trade Desk, Magnite, PubMatic is, if you want fundamentals, PubMatic is probably your best bet. I prefer Magnite over PubMatic because I think it grows more, but you could pick a side. If I stood up next to a PubMatic guy and we had a debate, I think that we would probably come out tied. The only thing I'd give the other guy is PubMatic's fundamentals are probably better, and they also don't have any debt. So I don't Roku, you can throw them in there too because of their whole thing is free streaming. That's where the direction they're going towards. And that would be heavily impacted by advertising budgets too. So yes, Eric, I think that ad tech sector is in a very bear market right now. The one thing that can save us is January, when the Q4 earnings come out, and maybe they surprise. Maybe they surprise and say, haha, you guys thought that we lost auto and travel ads and we weren't going to make any money. It turns out we were inundated with mortgage ads or whatever's going on TV right now. So that stuff can happen. I think long-term, Trade Desk, Magnite, PubMatic. There's probably others. Apps, Digital Turbine is getting hit by all this. That's a popular pick right now that shows a lot of fundamental promise. I think that you close your eyes and hold if you can reasonably afford to double down. See, that's where I'm in the fork in the road because I'm approaching 50% down. If you can reasonably afford to double down just by adding a few shares, then I would double down on some of these that you believe in, okay? I just struggle because of where I sit with Magnite. And one of the scenarios, by the way, that I'm considering is I have some shares of Magnite that I purchased much higher than $16. Maybe I trim the losses, right? Because they'll inevitably sell the oldest purchased shares, right? So let's pretend I bought a share at $50 and we're at 16 today. If you do this right, you can share the 10 shares you bought at $50 and keep the rest, bring your cost basis down without bailing entirely from the stock. So I just have to think about it more. We'll see where it lands. All right. Sunshine NG, will market go lower? Not today, it doesn't look like. We've got S&P. Where's that? Up top here. You guys can barely see it. But we've got S&P plus 1%, Dow almost 2%, NASDAQ plus 5 or 0.5. Russell, this would also be good for your Magnite PubMatic folks. Russell's been crushed, absolutely crushed, and seeing a little life in there is good. In fact, I don't know if we can squeeze this in. Apps is down. Sorry, PubMatic up 0.03%. So it's a nice, it's at least showing some signs of life there. But as far as the market going down in the future, I say that there's potential for that. If I had to put, let me do this just for kicks. This is just me throwing darts. I say that there is at least bare minimum 40+% chance that the market goes down lower from here before December 31st. And even with today's sort of mild bounce back, I could still see it going down. And, that's not much of a statement because you only have two ways that you can go in the market, which is up and down. I'm leaning more for myself. I'm more glass is half empty right now. Okay, but what we've seen over the past 2 years is just incredible buying, right? Just every time something gets to a certain level, buyers come in and boost it up. I think Bitcoin's a great example of that in the crypto market. It went down, and it wasn't a huge run back up, but there was a decent chunk of buyers for cryptos after the Saturday early morning crash. I was surprised that, in those situations, things can either free fall. Okay, so let's just say Bitcoin went to $45. After a big hit like that, there's either the panic with huge sell-offs that bring in a free fall, or there's support where people are like, I like this price, I'm going to buy at this price. I think that we still have some names, like I showed you, even Microsoft in all of its glory. I think that if you had panic with downward momentum, that you could see more. Like, why wouldn't you be able to? It's not like Microsoft at 322 is the greatest deal of all time for the next 1 year, right? It's probably a great deal for 10 years, but everybody out there is used to looking for those alpha returns. And then, so that's where, Microsoft could still have weakness even if it runs under 322, to be honest with you. All right. For tech stocks, what do you think of Facebook? I don't think you can go wrong. I mean, Facebook they have so much money. He likes the revenue growth. This is Tay Mila. Like the revenue growth and the numerous issues they face seem to give it a fair valuation. I agree with all those things. Obviously, if you like Facebook, it goes without saying that you should be pretty keen on the metaverse pitch that they're doing now, that how that world will change. You obviously should believe in that because they're spending billions of dollars on it. So if you're not keen on the metaverse talk, then Facebook's probably not for you. But they have a lot of good signs of being a solid stock outside of, speaking of SEC and consumer advisory panels, like they can't get hit anymore. They got billions of dollars in cash in the bank. They have multiple platforms to experiment with. It's just hard, like the chips are on their side. Whether or not they execute or they invent the next best thing remains to be seen, but there's worse bets out there than Facebook, that's for sure. All right, Dollar General up again. Yeah, I haven't looked at Dollar General in a while, but don't forget it's retail. This is for DH, I'll type it in. See what we got going on. 6 months. All right, so you peaked at 238. Trailing is 22 with an EPS of, 10 some dollars. This year, 1018. I can't read. It's hard for me to tell if they go to June or if they just go to January or whatever. But let's just round that out to 1050. Thanks, Tay. And then 1124 for next year. Let's just do this. 11. Let's give them the benefit of the doubt and say 11 on the end of the year EPS. Single digit growth rate, they're so big that's probably okay, but just know that you're never going to wake up and get sales figures that hit 5-10%. So ideally, if you're going to play this game, single digit growth rate, then you're going to excel at your EPS. I'm not seeing a huge boost here, but now I want to get historically, you're in 16, you're in high teens, pre-COVID on retail. Sorry about that. Pre-teen. So how about we give them high end of 19, and then I'm just going to say, I have to do a calculator here, 19 by 11 puts you about $209. So I say they're reaching the top of what they're going to reasonably do at this price. So if you got in lower, congratulations. This was the time probably before this run up. I would not double down yet. I would look for something under 200 if you ever even see it. So that's my 2 cents there, DH. Chestad did a little buying today, maybe tomorrow. A rebound dip. Yeah, I feel like every day it's sort of exciting, finally. It's sort of exciting to wake up in the morning. I'm kind of re-energized because it's like, hey, which way did the market go today? It used to be the Captain Obvious answer of course it's up 1% because that's all it ever does. And now we see some days that's like, let's see what's going on here. And for me personally, being long-term, I've made my fair share of short-term mistakes this year, but from a long-term perspective, I'll take red days. I don't want cataclysmic red days of 20% and, tickers being frozen and switches being shut. But I do like to find what I think are discounts. And for me, that's been a little refreshing over the past 2 weeks, even though it has cost me money just to have just to be able to buy with a little bit more confidence, I think is the big difference. Being able to buy something when you're like, okay, the floor is low, the ceiling is high, let's do this. Whereas opposed to, we were reaching some times where it's like the floor is low, very low, and the ceiling is limited. Do we still want to do this? That makes it much harder. All right, Lion, how's it going? Lion's big Facebook fan. CPI, yeah, so the Consumer Price Index, I don't know when that's coming. That's coming out this week. Let me see if I can get a quick quote. 4 weeks ago, it was, I don't know if it was Wednesday 4 weeks ago. So I'm guessing it's Wednesday this week. I don't know what time. This one was published, I'm looking at last month's, by the way. So I'm sort of making this up just by kind of deducting what I see here. So we published on Wednesday, November 10th, 8:31 a.m. So I'm going to just assume it's coming in on Wednesday this week at approximately 8:30 a.m. Okay. Yes, so I don't know what the market reaction will be to that, but basically, when you see consumer prices go up, if you want to get like way macro on it, you would assume that customers would buy less items, right? So if you still spend $300 at the grocery store or whatever the number is, inevitably, the time you did that 6 months ago and the time you did it today, you'd be walking home with less things. And so while that's not bad from an overall revenue standpoint, typically it does affect discretionary spending in some ways. And then it also affects unit sales. So I'm trying to think of who would be big on unit sales. Gosh, computers, cell phones, so thinking about Apple, they might still make a margin and they might still make revenue, but their unit sales could tank or be limited or missed expectations. So just depends. I feel like the market has an excuse or a reason for everything. So I can't say for sure that if CPI goes up that we're going to tank, but there is a lot of concern about it. I'm almost always, in a comparison of events, I'm way more interested when the Fed speaks because it feels like no matter what they say lately, they tank the market. So I don't root for that, but I just feel like every time Jerome Powell comes out of his cave and yelling to boot, man, do they have the power to tank things? Igor, you can say sell by highest cost basis as well, right? So you were talking about my Magnite, and if you just joined, I have some Magnites that are shares that are terribly sunk, and then I have others that are not down too bad. And so I might, because I still believe in the company, I might trim some of those top losers just to but still stay in the stock. So in case it does skyrocket. Not even skyrocket. Who are we kidding? It just allows me to preserve some shares that are more than a year old when selling time comes, and then I get into capital gains. It's just like dumb things you can do to kind of preserve a position without like exiting it entirely and trying to get back in 2 weeks later. Which you should never do. You should at least wait 30 days. Look up wash rule. All right, Lucid's long-term says up long-term, surprising me because it's expensive with Rivian. Yeah, I struggle with EV stocks in general, particularly the ones that just came out. But I do not blame anyone who buys them because certainly the 2026, 2025 story looks really, really good. It's just hard to tell, for me anyway, that these are good prices that are being offered today. And I think we've learned some of that from like a SPAC perspective, or I have. I know, I understand it's different. EVs and SPACs, it's different. But just the way SPAC prices rose up, and for me, anyhow, a misunderstanding of how that pricing model worked led to some shots that I took, namely PaySafe. That's about $3 right now, and that's one that I would consider, if they got a positive headline, getting back into. Unfortunately for me, I bought it at 15 and thereabouts. And it's not ever going to get back to that point at the pace that they're going. So that's why I worry about EV stocks for me, particularly the new ones, Lucid, Rivian, etc. I've been buying Visa the past couple weeks. I think it is close to the bottom. Unfortunately, I'll try to pronounce your name, Fakade. I think Visa 2 weeks ago or a week ago was a great deal, and I still think it's a great deal for the long term. So, and you could still see some negative headlines from Visa, because if COVID hits, it's a 1-year chart, if COVID does come back in any velocity, that whole cross-border transactions that I've said so many times on this channel, those are just going to be so slow to bounce back. But they will bounce back. And from an analysis perspective, Visa is pounding their EPS if they hit these numbers, right? So under $6 a year ago, now they're going to get to $7.05. Next year, potentially $8.50 or so. And, double-digit growth rate still. And looking at this, I would say this 2023 number is low, particularly if travel gets bumped out. So I think Visa is a safe stock, and I'm holding on to my shares, and I feel never lose sleep about Visa whatsoever. And I think perhaps if we wake up in summer and travel is travel again, if I can wake up and go somewhere, right, internationally, if I can wake up and say Amsterdam and go there in a plane, Visa is going to be in really good shape. But this winter looks like it's going to be tough, in my opinion, for international travel, not only with testing, but the prospect of people getting stuck in a place they don't want to get stuck in, right? I don't know who on earth would book like an African safari right now if you're in America, because those are huge expenses, and they're popular events, but who wants to get stuck there for 6 months and wait for some of this news to come down or some of these testing procedures to change? I wouldn't. So I wouldn't be surprised to see travel. The irony, switching very quickly, the irony is that travel is up today. I'll show you. It was up today. Let's see if it's still happening. Delta up 10%. Nice. And let me squeeze this in. Here's the rest of the airlines. Today, plus 10, plus 10, plus 5, plus 10. Oh, that's even better. Cruise stocks, they just had a cruise ship get everybody stuck on side because they had a COVID thing. No rhyme or reason why these are up. Airbnb, 7%. Even one of my cheap stock bounce back plays, Sabre, up 10%. So by the way, I still like Sabre long term. Buy it and throw it away. Buy it, throw it in the back of your portfolio, wake up in 2 years, see where you're at. And you see this one just got crushed. Now it's even bouncing back. I don't know why, these travel stocks are doing that. One interesting way to play travel, by the way, if you're like me and you're very confused, where should I go in travel stocks? You know, maybe you believe that they come back strong. Check out consumer discretionary ETF is the first place. I prefer one that's called IYC, but there are others. I believe there's XLY that I have a few too. That's all consumer discretionary. It includes a host of airlines, hotels. Most of them do. They're usually 300 tickers, 200 tickers in there. You'll get your hotels, you'll get your rental cars. That's a good way to play it. Because frankly, if travel comes back, consumer discretionary is going to be just straight balling. So think about that as an easy play. Tay, do you feel Amazon valuations is fair, even with 10 to 15? Yeah, I understand what you're saying about the pricey. So I have 3 shares of Amazon that I bought when it was really struggling to get above 3,000 or, you know, make a move. You're right that the PE at 67 is a little high. It's definitely higher than some of its counterparts in FANG. The reason that I'm not too super concerned in the long term is just because of what they're investing in. But, you know, I think it's fair to say that a PEG ratio of 2 on a stock this big, forward PE in the 50s, that it is probably one of the more expensive FANG stocks, certainly not counting NVDA and Tesla. Now, with that being said, you have to, I would say that of the popular FANGs, so let's call them Apple, Facebook, Amazon, Google, I think Amazon is putting more into a sustainable business model right now. I think Facebook is probably spending more on metaverse, but we'll have to see where that goes. But Amazon just turned into, I think, the #1, not freight company, but the #1 like parcel company in the United States. Okay, so I expect 2021 is going to fall flat. Disappointing. Okay, year ago under 42, this year under 41. Next year at 51, if you can look out that far, you're going to be fine. Maybe not at 3,400, although I wouldn't argue 3,400. But yeah, keep your eyes on a dip opportunity and hold Amazon with the expectation that 22 is your year, mid 2022. Okay, so that's how I'm playing it, and it is going to probably be a slower burn than I thought. What happened to me in Amazon with my projections when I was in the $3,000 range, let's see, maybe it was last quarter or the quarter before, they basically cut their EPS projections, okay? And that happens. It's part of the game. You know, I look a lot at EPS projections, and they don't always materialize. And in this case, Amazon is spending billions of dollars on their distribution service, and they're also raising wages to have enough workers to pull it off. So that has really affected profits. Let's be fair, though. They're still making $40 a share. But we were supposed to probably get a little closer to 47, 49 EPS at the end of this fiscal year and push next year into the 60s. So that changes the fundamental story from a short-term outlook, and those have went up, and that's what's kind of putting a ceiling on it for now. Would I buy I would buy Amazon over Apple without even thinking about it right now, just because I think that they can match Apple's growth initiatives. They're not going to match, like, they're not going to build an iPhone, right? But whatever Apple has up their sleeves to grow for the next 5 years, I think Amazon can do the exact same thing, if not more, with between AWS, package delivery, and the retail sector. If I put it against Microsoft, I would argue that it will be a little tougher to match Microsoft, except that they get the one for one, right? Microsoft's growth is entirely cloud. Nobody's buying, I mean, I have a Windows computer, but nobody's buying, running out the door to buy Microsoft Word as quickly as possible. But Amazon has AWS. Now that's turned into a hell of a battle there, and there's going to be a lot of money poured into those platforms to make them superior for enterprise customers. And my understanding on the enterprise side, Microsoft has a very strong foothold because of their trusted brand, how they can work with old or retired Windows programming. We'll see. But I flip a coin between Microsoft and Amazon. On the Google side, I would think about Google over Microsoft and Amazon. I picked up Amazon for a very specific projection that didn't materialize. I do think YouTube and what Google's doing is probably a little bit more powerful of a flywheel, but all those things put together is exactly why you should just buy the QQQ. I'm done buying Amazon shares, okay? But we're flipping coins between Amazon, Microsoft, Google, and throw Apple in there too. I want heavy QQQ for a decent side of my portfolio heading into 2022. It'll take a while to get there, but instead of me mapping out a barbell with individual names, just give me a big bucket of 100 awesome stocks, and then I'll balance against that. All right, guys. Lion, the story behind my name is just random because I am in my 40s and this is finance. It was not even, you don't make these names with the concept that you'll ever have anyone care about them. But anyway, Lion hates Fang. Mama is better. I haven't even seen that one, but it probably does make sense. Baba will dethrone Amazon 5-year battle, so says Lion. Roman Z, I will re-enter end phase if it drops below 170. So will I, Roman. And I'll buy end phase at that price just to spite all the people that go to my end phase. When I sold Enphase, I did a video and they're all like, oh, it's 250, it's 260, you're such a dumbass. And I'm like, all right, guys, that wasn't necessarily smart if I could have projected it. But the reason that I sold off was because it tanked in the opposite direction going on. It's a volatile stock, but I do hope I get to buy one share at a reasonable valuation because I just want to have something to show folks who are so freaking obsessed with that. All right, Google or Amazon for big tech, bought both, why not? Honestly, can you go wrong? I mean, these are the kinds of things with long-term investing that it's hard to argue any of them. If they all have a common problem, and it's not a proven problem yet, but Amazon, Apple, Microsoft, who am I forgetting? Google, they're all playing with fire on the Federal Trade Commission side as far as how much they want to stack a case against consumer whatever. Anytime that you own that much stuff, you're going to have people trying to knock you. We have a Democratic president who is, more than happy to go after them. So that would probably be their biggest risk. None of them, except for Microsoft or Apple, has China risk. They sell a lot of stuff to China. I'm not sure how that relationship's going. Amazon has no China risk. Google has no China risk. Microsoft, I don't know if they do stuff in China. So if you get anything with Google and Amazon, you get literally zero China risk because they're not in there. So that right now is a benefit. 2 years from now, that could be a negative. It's hard to tell which way it goes. But all right, guys, I got to roll. Shout out to everybody. Lion says Musk, Cook, and Bezos have said in the past the only company they're afraid of is Google, and it makes sense. Google is the force, is a force, and I agree. Google has probably, what's the word I'm looking for? Optionality is what they call it, so that a company can not only do what they do, but have options to spread their tentacles, so to speak. And I would argue that Google has the most optionality out of anybody in those top 5. So, all right, guys, thanks so much for coming out, and we'll see you on the next one. Take it easy.